How do you defend a ratio spread with adjustments? Have you ever wondered how to protect your investments when using a ratio spread in options trading? Today, we will break down the steps to defend a ratio spread effectively. A ratio spread is a strategy where you buy and sell options of the same type on the same underlying stock, but in different amounts. For example, you might buy one call option and sell two call options at a different strike price, creating a 1-to-2 ratio. This setup can help you profit from steady movements in the underlying asset's price or from changes in implied volatility. However, this strategy comes with risks that are not strictly limited. Unlike a standard vertical spread, where your risk is capped, a ratio spread can expose you to larger losses if the market moves sharply against your position. That is why defending a ratio spread with adjustments is essential for managing risk. To start, you need to identify your risk points. In a typical 1-to-2 ratio spread, your risk is highest if the underlying stock moves beyond the strike price of the short options. For instance, in a call ratio spread, if the stock price rises above the short strike, your losses can increase quickly as the price continues to climb. Next, set clear adjustment triggers. Before entering the trade, decide what price levels or changes in volatility will prompt you to take action. For example, you might choose to adjust if the underlying stock approaches the short strike or if implied volatility spikes. Now, let's talk about common adjustment techniques. If the market moves against your position, you can roll the short options to a higher strike price for calls or a lower strike price for puts. This effectively moves your risk point further away. Another option is to add a long option at a new strike price to cap your risk, which can convert your ratio spread into a vertical or butterfly spread. Additionally, closing out part of the position can reduce your exposure, especially if the market moves quickly and exceeds your original risk parameters. Managing your trade size and margin is also important. Since ratio spreads can have undefined risk, keeping your position sizes small relative to your total account is wise. This approach gives you the flexibility to adjust if the market moves against you. Monitoring implied volatility is another key factor. Ratio spreads often benefit from falling volatility. If volatility rises, the value of your short options can increase, making your position riskier. Adjusting by rolling or adding long options can help mitigate this risk. Lastly, stay disciplined. Stick to your adjustment plan and avoid making emotional decisions. Your adjustments should be based on predefined rules, not on market noise. Defending a ratio spread with adjustments involves monitoring your position, setting clear triggers, using techniques like rolling or adding long options, managing trade size, watching implied volatility, and maintaining discipline. Following these steps will help you manage risk and protect your capital in options trading.